Good morning, everyone. Thank you for joining us for the inaugural fund update with Amy Pham, the portfolio manager of the Pengana High Conviction Property Securities Fund. My name is Adam Myers and I lead the distribution team at Pengana. To give a quick introduction to those who are less familiar with our business, at Pengana we offer a diverse range of strategies investing both locally and abroad. The consistent thread across our portfolio of funds is differentiation, and our key aim is to offer strategies to our clients which add value to their portfolios. The High Conviction Property Securities Fund is the most recent addition to our range. Amy is a very well-regarded and experienced manager, and the High Conviction strategy with an ESG focus offers a great deal of differentiation with the potential to add significant value to portfolios in a space where the lion's share of the assets track the benchmark or are completely passive. During the presentation, if you have any questions, please enter them in the question box on the top right-hand corner of your screen, and we will get to as many of them as possible in Q&A at the end. Amy, over to you.
Thanks, Adam. Good morning, everyone, and thank you for joining us today, wherever you may be, whether you're working from home or have started to come back into the office. As it is a relatively new fund, I would like to briefly touch on the team, the sector, our point of difference, and how we go about investing, the current environment with COVID-19, and finally, how we are positioned. To the next slide. The investment team is made up of myself and Jade Ong. I have over 20 years experience in property funds management. Prior to joining Pengana, I was managing the high conviction AREIT fund at Charter Hall Maxim. I have a track record in establishing and growing AREIT businesses. The first one was at Paladin in 1998, IAG in 2002, and Folkestone Maxim in 2014. Jade has over 17 years experience in property funds management and corporate finance. She was the senior member of the real estate corporate advisory team at Macquarie Bank for 9 years. Most importantly, we've worked together at IAG for 5 years. Over to the next slide. Looking at the key attributes of the sector, it offers solid yield as most of the income is derived from long-term leases, typically 3 to 5 years. It preserves capital in that the NTA is transparent and can easily be verified. It provides real growth in that the leases are indexed to CPI. It provides liquidity through the daily unit pricing, and also we only invest in AREITs with a market capitalisation of more than 50 million. It also provides sound ESG matrix in that most REITs rank highly under the Neighbours Initiative and have good corporate governance compared to our global peers. In slide 6, so how do you get exposure into this market? Well, there are currently 25 active AREIT managers that are managing 10 billion out of the 103 billion. With an average tracking error of only 1.3%. So what it tells you is that they're not adding much value and they're just tracking the index. The main reason for this is the concentration of the index. And this is the reason why, if you look at the chart above, that there's been, over the past 10 years, there's been a significant amount of money flowing into passive funds. Now, if you've been investing in these passive funds in the past few years, you would have done quite well in this low interest rate environment, acting as tailwinds and driving cap rate compressions as much as over 200 basis points in the last 5 years. However, we think that the easy money has come to an end. Looking forward, COVID has not only caused cyclical impact, but also structural headwinds. And the main casualty of structural shifts is the passive investments, as it does not take into account of the earnings risk. What we offer, next slide. What we offer is high conviction and ESG focused fund with an aim to provide capital security and income yield. The main reason for adopting a high conviction strategy is that, as I mentioned before, the index is highly concentrated, with the top 8 stocks making up more than 80% of the index. Not only this, it is highly weighted to retail assets. We look outside of the index at the opportunity of investing in new growth sectors such as data centers, logistics, childcare, and seniors living, all of which provide more sustainable earnings from secular trends. We incorporate ESG into our risk analysis to provide us with a complete view of the risk-return profile of our investments. Also, ESG is becoming a requirement for high-quality investors such as family offices and non-for-profit organisations, whereby they want to align the values and beliefs with their investments. On to the next page. So our objective is to outperform the S&P and ASX 300 AREIT accumulation index over a rolling 3-year period. The strategy is to identify mispriced securities through high conviction and ESG focused approach. The management, I have a track record on high conviction investing. And similar to the other Pengana funds, I am an equity owner and investor in the fund. The outcome is to achieve a high total return with low volatility, exposure to investments outside of the traditional core sectors of retail, office, and industrial, and a better risk-adjusted return from ESG focused. On to the next page. So our investment process incorporates qualitative, quantitative, and fundamental research and analysis, all of which you would expect from a sound investment process. What we do differently is that we focus on secular themes, which helps us to identify growth sectors and structural shifts, include ESG into our risk analysis, and do a lot of the groundwork ourselves. We would only invest in REITs after I have met with management and understand their business and strategy, have seen at least 50% of the assets, and also build our own financial models. On to the next page. So this table here on slide 10 illustrates how ESG is applied to property. We incorporate ESG into our risk analysis by engaging with each of the management and rank them in terms of the E and S and G. For example, under E, we assess the sustainability and energy efficiency targets. This is important because it lowers the cost for the tenant, and in return, we can attract higher rents, better quality tenants, and with longer term leases. On to the next slide. Looking at the snapshot of the portfolio, it is a concentrated portfolio with a maximum holding of 20 securities. The weighting is based on the level of conviction and sector diversification. For index stocks, our holdings range from 0 to 20%, which means we are pretty much index agnostic. For non-index stocks, we hold roughly from 2 to 5%, and we have a maximum cash holding of 20% with relatively low turnover of 30 to 50%. Now, most people think that high conviction means high risk, but in actual fact, if you look at our performance over the 1 and 2 year period, we've actually outperformed our active peers and index while having a lower risk than our peers and the index. On to the next page. This chart here looks at our upside and downside capture. What it shows you is that that we're not going to shoot the lights out when the market is up 20%, but when the market is down 20%, we're only down less than half of that. By adopting a conservative 86% upside and 47% downside, and extrapolate that over a period of 10 years, the strategy would have delivered a 10-year annualized return of 14% versus the benchmark of only 8%. On to the next slide. Now, traditionally, the AREIT sector is quite defensive and has low volatility compared to the equities market. However, COVID-19 has materially impacted the sector, with the sector being down over 20% since February. It has also widened the dispersion in performance of individual subsectors, with retail being the most impacted, followed by office and industrial. So in the short term, due to the earnings uncertainty, the majority of AREITs, in particular retail REITs, have withdrawn their earnings and distribution guidance. And for the first time, under the Code of Conduct, landlords are now being asked to share the pain with their tenants by providing rent relief. Looking at April's rent collection, the retail landlords were able to collect only 30 to 40% of last year's rent. For office, it's 70 to 80, and for industrial, it's 90 to 95. Also, what we've seen in the last couple of months is that there's been an increase in capital raisings as companies look to strengthen their balance sheet and provide flexibility for growth opportunities. So in the long term, there is also cyclical headwinds, which include higher unemployment rates and lower GDP growth, which will impact on tenant demand, vacancy rate, and market rents. Importantly, COVID has accelerated some of the previous structural change, such as the adoption of online retailing and more flexible working environment, such as working from home. So looking at each of the sectors, within retail, most of the large retail landlords, which are exposed to discretionary retailing, has been mostly impacted and are trading at large discounts to NTA of about 40 to 50%. However, we see this having the most downside risk to earnings going forward, as it suffers from both cyclical and structural headwinds. In Australia, the penetration rate of online retailing has been relatively low at around 11%. With COVID, this is expected to increase to 19% over the next 2 years. With the increase in retail consolidation and increase in online presence, we expect that the shift of power will move from the landlord and towards the tenant. With this, we expect that there will be a rebasing of rents and shorter lease terms going forward. So as a result, we're factoring in a 20 to 30% fall in valuation for regional malls and 5 to 10% for convenience centres, as they are more defensive and exposed to supermarkets and essential services. For office, with unemployment rate at an all-time high of 10%, it would definitely impact on the tenant demand, vacancy rates, and market rents. What we've learned from past downturns is that when the vacancy rates increase from 4% to where it is now, which is when it increased from 4%, which is where it is now, to the level of about 10 to 15%, net effective rents decrease from about 20 to 25%. In terms of structural shifts, it is too early to determine how successful the adoption of working from home. However, companies now know that with the existing technologies available, certain functions can be done from home. However, offsetting this is the space required for physical distancing and the elimination of hot desking. So net, we're expecting a 25% fall in valuation for CBD office and a 15% for metro office. Now, retail, we think, will be the one that will benefit out of all this. Logistic assets, which form part of the supply chain for food and delivery of parcels have shown that to be quite resilient. And in actual fact, there's been an increased demand from online retailing. With that, we're factoring in a 5% fall in valuations, mainly towards the smaller logistics centres, which are more exposed to the SMEs. In residential, with the increase in unemployment rate and moderation in migration, it would have a negative impact on demand. However, this is partially offset by a reduction in interest rates and expected reduction in supply in both existing stock and new. So we're factoring a fall in sales of about 20 to 30% and a 5% decline in price. However, we think that in the long term, there'll be more of an upside risk than downside risk, as we know that during downturns, the government is supportive of this sector, especially in the first home buyers market. Over to the next page. So how are we placed? As you can see from the table, we are underweight the core sectors such as retail and office. For the diversified sector, we prefer the long WALEs and assets and logistics and office assets, such as the Charter Hall Long WALE and Mirvac. For retail, we do not hold any of the large retail landlords and instead prefer the defensive retailing, which has more exposure to supermarkets and essential services, such as the Charter Hall Retail REIT. For office, we prefer metro office over CBD office, such as the Charter Hall Office Trust and also the Australian Unity Trust, as they have longer WALEs and also exposed to more government tenants. For industrial, we prefer the high quality assets which with a strong balance sheet to take advantage of the growth opportunities through either development or acquisition. In the specialised sector, we like the seniors living model, the manufactured home estates, and also childcare. In developers and managers, we prefer the high occurring earnings and strong balance sheet, such as this Centuria office. So because we focus a lot on positive cash flow, strong balance sheet, not just LVR, but ICR, and also sustainable earnings through positive thematic drivers and long WALEs, the result is that 4 out of 15 holdings, of our 15 holdings, have reaffirmed their earnings guidance compared to 4 out of 30 in the benchmark. And we don't hold any of the stocks that have withdrawn or cut the distribution. We've also diversified away from discretionary retail assets into seniors living, manufactured housing, childcare, and logistics, all of which provide a sustainable earnings driven by secular trends. In summary, the AREIT is far better positioned than what it was during the GFC, as gearing is much lower at 27% compared to 45%. And liquidity is also better as the more diversified source of funding and longer duration, which helps it in terms of not having to raise capital during and being diluted to earnings. However, COVID has created both cyclical and structural headwinds. To deliver on capital security and income yield, we remain focused on investing in REITs with sustainable earnings growth through strong balance sheets and favourable thematic drivers. Over to you, Adam, for questions.
Thank you, Amy. Thanks very much for a very comprehensive overview of what you're looking at the moment. A number of questions have come through. I'll try and group them to the greatest extent possible, just to make it easier to answer them. The first question is that the pandemic is obviously not going to affect all sectors equally. You touched on retail and office as pretty hard hit, with industrial and residential as adversely affected as well. Where do you see the greatest opportunities?
I think the greatest opportunities will exist around the industrial sector, especially the ones that form a supply chain for the e-commerce. So they're the ones where we think that over the next couple of years will be the only sector whereby we have cap rate compression instead of expansion, like what we would have expected from the retail and office sector.
Great, thanks, Amy. The next question is, a few of the large retailers have come out to say that they are not paying rents during the pandemic period. What do you think the outcome of this is going to be?
Yeah, that's been quite topical. As I mentioned, landlords are currently working with their SME tenants under the Code of Conduct for rent relief, in the government's initiative to share the pain. For larger tenants, though, this is less clear what the rent relief will be. However, we must acknowledge that the rent is contractual and that companies are obligated to pay this. This is why it's so important for us to focus on long WALEs, as it limits the risk for landlords.
And Amy, just in case people aren't familiar with the term WALE, can you please explain it to people?
Yes, sorry, it's just a jargon. It's the weighted average lease expiry profile.
Okay, great, thank you. The next question is, what is the attraction for investors to invest in the sector in the current environment?
Yeah, look, I think once the dust settles, people will start to look at defensive nature of the sector and the income yield that it's providing relative to the rest of the market. Currently, the income yield of the sector is 5.8%, with earnings growth of about 1 or 2%, which I think that in this low interest rate environment is still very attractive.
Great, thank you. Next question, you mentioned MHE data centers and senior living. How much exposure do these sectors do you have, and how much sort of exposure is there through the index stocks? So basically, I guess the question is it necessary to invest outside the index to gain this exposure?
Yes, well, I think for us, there's not a lot of data centers out there at the moment. There's only two key players. There's the NextDC and the 360 Digital Capital Group. Now, we like the sector, however, because some of them do not meet our criteria of positive cash flow, or that it doesn't have long WALE, or that it doesn't have a strong balance sheet. So we're very, very critical in that even if a sector, it looks good thematically, it also has to satisfy the financial assets, the financial side of it. So, at the moment, we like the manufactured home estates, and we have quite a large investment in Ingenia. Because I think going forward, the focus, if we're leading into this recession, I think the focus will be affordable housing, and that will be very, very important on the agenda of most governments going forward.
Great, thank you. Could you please provide your view on our approach to Goodman at the moment?
Yeah, well, I think Goodman is one of the ones where I think it was last year where it overtook Scentre Group as being the largest REIT in the sector. It has grown dramatically over the past 10 years. It's very, very well run, but if you just look at the valuations and not capture the thematic side to it, it's always going to look expensive. So for us, we actually have one of our highest weighting is to Goodman for that very reason, because we look at the thematic drivers, and Goodman, out of all of the REITs, have got the best position in terms of having the right assets and having the good management and strong balance sheet to ensure that they're able to deliver on an 11% EPS growth that they've guided the market to.
Great, thank you. Next question, have you had to exclude many stocks for ESG reasons?
Yeah, look, we haven't. So we exclude based on ethical screening. So we screen out stocks that has a moderate amount of their earnings that are towards gambling, tobacco, or alcohol. And at the moment, or if it has like poor corporate governance. So at the moment, we've only got 3 stocks that were screened out based on those factors.
Okay, great. 2 more questions. The first is, a number of REITs have raised capital in the last few months. Have you participated in any of these raisings?
Yes, we have. And going into this pandemic, we've been quite cautious in that we've held quite a large amount of our holding in cash at 17% currently, and this is to take advantage of any pullback to buy or participate in a few of these capital raisings in the trust that we either want to own or have already owned and know the management and like the stock, and we want to support their growth strategies going forward.
And the last question was relating to your cash position, which you've answered as well. So I think under the circumstances, we will wind up there, Amy. Thank you very much for participating in the webinar today, and to everybody out there, thank you very much for joining us. A recording of this webinar will be available online at pengana.com/webinar. I hope you found this webinar useful. I guess my key takeaway is the value that active management can add, particularly in the current environment. If you have any other questions, please get in touch with us directly. We'd love to hear from you. And thank you all very much for joining us today. Goodbye.
Thank you.